Good afternoon, everyone. Thank you very much for coming. It's nice to see some familiar faces, and it's also nice to see a lot of new faces out there. If you'll notice, those of you who've been coming to the roadshow for 3 years now, every year we need a bigger room in Sydney, so that's a very good problem to have. Thank you all for being here. So as you may know from the news, there's a lot going on in Asia these days. So we have a full agenda ahead of us. There's a couple things I want to talk about today. The first is making the case for why you should be invested in Asia. The second is the outlook for Asian markets going forward. The third is a portfolio discussion of how we're invested right now. And then lastly, an update on EAI, the stock and the dividend and the options. So that's a lot to cover in 30 minutes, so let's get started. So first of all, in terms of why Asia, as Brian said, we believe that Asia is the best structural growth story in the world. And we also believe that every portfolio needs some exposure to growth. And so if you need growth in your portfolio, Asia is a great place to get it. You can see on the chart on the left-hand side, GDP growth in India is over 7%. GDP growth in China, despite everything that's going on with trade, is still around 6.5%. The average GDP in the markets in which we invest, the average GDP growth is still 6%. So that's 2 to 3 times higher than the GDP growth in developed countries like the US or Australia or Europe. So the good news is that high GDP growth is translating into earnings growth for companies. We are a growth fund. We only invest in companies that have high earnings growth. The chart on the right-hand side shows what are you paying for this growth. So we like to use a ratio called the PEG ratio. It's the PE divided by the growth rate. So this gives you an idea of what you're paying per unit of growth. So if you look at the ASX 200, the current PE is around 14 times, but you're not getting very much EPS growth, only around 5%. So that means the PEG is around 3 times. The similar statistic for S&P 500, 15 times, 10% growth, 1.5 times PEG. In our portfolio, however, we have 16% EPS growth in the portfolio on average. That's very high. That's more than 3 times what you're getting in Australia. And the PE of our fund is only 15 times on average. So you can see the PEG ratio. What we are paying per unit of growth in Asia is much less than what you're paying in Australia or in the US. So why Asia? We think you need exposure to growth, and Asia is the best growth story out there. So the next slide talks about why now. As you may know, Asian markets have traded off this year. The MSCI Asia ex Japan, which is our index, is down over 20% since the January high. And markets like Shanghai Comp and Hang Seng Index are down between 23 and 26%. So this is a significant fall. At the same time, S&P 500 hasn't really corrected at all. We did this slide at the end of last week, and it was only down 5%. There's been some movement since then. But you can see that there's a big jaws that came out between the way the US was trading and the way that China is trading. And you know, there is a trade war going on, or a trade conflict going on, and it does have negative implications for China. We'll get to that later. But it also has a lot of negative implications for America. If you think of the impact of it, it's very negative for supply chains of American companies. It's negative for potential sales of American companies. And it's negative for the American consumer. So for quite a while, we've been thinking that this big gap between where US markets are going and where China is going has been unsustainable. And that one of those things has to correct. Either the US has to go down or China has to start going up, or both, but that gap is untenable. The other implication of China selling off this year, and Asia selling off, is that valuations are now very, very compelling. So you can see on the chart, Hang Seng Index is now at 6.9 times PE. That is very, very inexpensive. The market as a whole, the MSCI Asia ex Japan, is trading at 11 times. That's versus its long-term average around 13.5 times. So these markets have become very inexpensive. On the other side, you can see S&P 500 and NASDAQ are still at 15 times and 19 times respectively. So the value that you're getting in Asia right now and the value you're getting for the growth that's still in the economies is very, very compelling. However, we feel that valuation alone is not going to be enough to reverse these markets. People aren't going to go to bed one night and things be at 7 times PE and then get up the next morning and say, they're at 7 times PE, I'm putting all my money back in. We think there's going to need to be a catalyst. But the good news is there are some important catalysts coming up. So I guess the first one is the potential catalyst is the midterm elections in the US on November 6th. I don't know who's going to win. I don't know if anyone knows what the outcome is going to be, but there could be very different policies from Donald Trump after the midterm elections. There's also some important policy meetings going on in China right now. There were some comments last night from the Politburo, and between the 7th and 9th of November, there's a plenum going on. So we could see some very important policy announcements coming out of China in the next few weeks. Thirdly, there is a very important meeting at the end of November. It's the G20 meeting in Buenos Aires, and both President Trump and President Xi are slated to attend and have a meeting on the sidelines of the G20. So there is some speculation that they're going to meet and there will be some de-escalation in the trade war following that event. So these are some potential catalysts that are coming up, and we are not changing our positioning right now. But as I said before, Asian markets have sold off a lot, and Asian markets are now very inexpensive. And if we do get a positive catalyst for a reversal in the markets, there's a lot of opportunities. So the next slide also talks about why now. We wanted to see how does this current correction compare to corrections in the past. And I've actually been working in Asia. I started my career working in Asia during the Asian crisis. So I've been investing in Asia through all of these. We went through and we looked at what happened during the Asian crisis, the tech wreck, SARS, the GFC, the taper tantrum, and the RMB devaluation in 2015. And we wanted to see two things: how long was the duration, and where did markets bottom? So what we found is that these corrections, you can put them in two different buckets. The first one is the big ones, and the second one is the smaller ones. In the big corrections are obviously the Asian crisis, the tech wreck, and the GFC. In those corrections, markets sold off between 50 and 60%, and the corrections lasted generally over 18 months. In the smaller corrections, which are SARS, taper tantrum, and RMB devaluation, they lasted between 4 and 5 months, and markets sold off around 20, 21%. So you can see, depending on your view of the world, if this is a big correction, then we're only about halfway through. If this is one of the smaller corrections, then it looks to be near the end. My view is that this is not one of the big corrections. This is not GFC 2.0. This is definitely not an Asian crisis. We have checklists on our team that go through, it's a bear market checklist. And if you look at some of these big corrections like Asian crisis or tech wreck, there were a lot of things that characterize the markets prior to these big corrections. For example, there was extreme valuations. There was certain corporate behavior like IPOs and lots of M&A. There was sentiment was euphoric, or people who measure risk-love indicators. It was all love and nobody thought anything about risk. Cash levels were very low. Balance sheets of corporates were stretched. We have a whole checklist of 10 things. When you go through them, the market right now is not checking a lot of those things. So to me, this seems more like a taper tantrum plus a trade war sort of correction, which means that, in my view, we're closer to the floor than we are to the ceiling in this correction. So the second thing we wanted to show by this analysis, what happens to Asian markets after they bottom, after there's been a correction, and they start to reverse. The good news is they reverse very, very sharply, and they recover the ground that they've lost. So for example, 1 year after these crises, on average, markets were up 54%. So when I don't know when markets are going to reverse in Asia. It could be on November 6th. It could be later on. I don't have a crystal ball. But I feel quite strongly that when they do reverse, there is a lot of buying opportunities in Asia, and the markets are going to perform very strongly. OK, the next few slides are about debunking myths about investing in Asia. So as Brian's slides show, I've been doing a lot of marketing and meeting with a lot of investors this year, hundreds of investors. And I kind of know what the pushback is about investing in Asia, so I've developed some slides to preempt your pushback. So the first thing that I often hear is, there's too much political risk in Asia. I love the growth story, and I hear Tencent's a great company, but there's just way too much political risk. So I just wanted you to think about the context of the world right now and political risk globally. Obviously, you have a lot of political risk in the US. You have Brexit going on in the UK. You have Italy and Germany and a lot of political risk there. And then obviously we have Australia. I'll tell you a story, during the last prime ministerial shuffle, should we call it? I was talking to one of our brokers in India. She said, "What's going on down there?" And I said, "Yeah, I know, it's a bit of a mess." She's like, "India's only had 14 prime ministers since independence in 1947. And I said, "Yes," and we've had 5 in 5 years. So the reason I'm telling you that is there's a perception that political risk in Asia is very high, but it's actually not nearly as high as you think. That's why I put in this chart on the left-hand side. This is sovereign CDS spreads, so this is credit default swap spreads. This is the cost of insuring against default on a sovereign bond, and it's a numerical indicator of perceived political risk. So if you go down the list, obviously the most risky country is Argentina, that's fair. Greece, Turkey, Brazil, Italy, Russia. So you notice we're halfway through the list, and we haven't even run to one Asian country yet. Then Indonesia, that is fair. There is some political risk and some macro risk in Indonesia. And then you have Portugal, which is roughly in line with India and the Philippines. And then you have China, which is roughly the same as Spain. And then you have Hong Kong, which is roughly the same as the UK and France. So the point of this graph is that if you don't want to invest in Asia, that's fine. But saying that there's too much political risk is not a good enough excuse, in my opinion, in 2018. The second thing is that corporate governance in Asia is poor. As I said, I started working in Asia during the Asian crisis, and at that time, corporate governance was pretty bad, I will admit. But Asia has made significant improvements in corporate governance since then, and it is getting better, and I would like to highlight that there is corporate governance everywhere in the world. I mean, how many of you watch the Royal Commission on TV? I was actually in Hong Kong that very dramatic day when the guy got wheeled out on the stretcher, and I met with some of our traders up there. If any of you have ever been on a trading floor, usually they have TVs, and people are watching CNBC or Bloomberg. And one of the traders said to me, actually, we've turned off CNBC and Bloomberg and we're watching the Royal Commission because it's so much more entertaining. It's like reality TV and we can watch it during work hours. So this is the impression that other people have of potential corporate governance in Australia. So again, my point is not that corporate governance in Asia is great, that there's no corporate governance risk, but it is the differential between corporate governance risk in Asia and in Australia is much, much less than you think. And then lastly, on this slide, people often say to me, again, I love the growth story, but investing in Asia is too risky. So we put this pie chart up from the ATO. This is the average SMSF asset allocation. And as you can see, only 1.3% of the average SMSF portfolio is in global assets. That's not global equities, that's all global assets. And then a fraction of that is in global equities, and a small fraction of that is in Asian equities. So I'm not a financial planner, I can't give official advice, but if you ask me, the major risk there is not the teeny tiny little sliver that's in Asian equities. The risk is the concentration risk in that big red part. So again, I have a sort of different view, and I encourage you to have a different view of what risk means in an Asian portfolio. Okay, a few more myths. One is I can get exposure to Asia via domestic stocks, and I'd rather do that. That is sort of true, but look what you're paying for diluted or non-direct exposure to Asia in Australia. The first one is A2 Milk. Only 25% of their sales are to China or Asia, and you're paying 29 times PE. Blackmores, similarly, less than 30% is to China and Asia, and you're paying 25 times PE. If you remember from that first chart, in Ellerston Asia, you're getting 100% exposure to Asia, and you're only paying 15 times PE. Similarly, people say, well, I'm sure I'm getting exposure to Asia through my global fund. Well, the MSCI World Index, only 2% of that is in Asia, so you're not getting that much exposure. People say, oh, but through stocks that I own in the US, I'm sure I get China exposure. Well, you might be able to do that, but again, it's diluted and expensive. So Starbucks, only 15% of their sales are in China. That means 85% of their sales are not in China, and you're paying 24 times PE for that diluted exposure. Nike is the same. Small exposure, high PE. But in Ellerston Asia, you're getting 100% exposure at 15 times PE. Okay, so let's move on and we'll talk a little bit about the market outlook. There's a couple things I want to cover. The first is the trade war. The second is potential domestic stimulus in China. And the last one is an update in terms of the technology sector in Asia. So update on the trade war. For those of you who follow our monthlies or who subscribe to Livewire or some of the other things that we contribute to, for almost a year now, we have been outlining 3 specific scenarios in the trade war. And the probabilities we assign to each have changed over time, but the 3 scenarios have stayed the same. The first one is tit-for-tat escalation. So this cartoon is meant to depict, Trump hits Xi over the head with tariffs and goes back and back and back, and they just keep bonking each other over the head. This has largely played out. Obviously, they had the 50 billion tariffs and then tariffs on 50 billion, tariffs on 50 billion. The US has gone up to 200 billion, and there's a threat that Trump will impose tariffs on an additional 267 billion in 2019. If and when that happens, then that constitutes tariffs on everything that China ships to America, and the tit-for-tat escalation on tariffs on goods is pretty much over. The second scenario is a negotiated outcome. So this is obviously our preferred scenario, and I think everyone in the market's preferred scenario. We spend a lot of time on the ground in China, and one of the things we've picked up is that of the sort of US demands of China in the trade war, they fall into 3 buckets. The first is things that China could agree to now. So these are things like reducing the deficit by importing more soybeans or importing more oil. That's relatively easy to do quickly, and China could agree to that. The second bucket are things that China could agree to over time. So these are things like opening up the economy for autos, financial services, dismantling some of the barriers to entry for US and international companies. These things are also tenable to China, but they might take 2 or 3 years to achieve. The third bucket is what we call the non-negotiables. So this is America's demands that China back off from its China 2025 policy. And this is China's industrial policy, and rightfully so. They don't think that Donald Trump should be able to dictate their own industrial policy, and they're not going to negotiate on that. So the question now is, when Trump and Xi meet at the end of November, can they find enough common ground in those first 2 buckets that there can be a de-escalation in the trade war? And then the last scenario is what we call extreme retaliation. This is if there's no negotiated outcome, tit for tat has run its course, there aren't very many other options, and it gets very, very heated. There are some extreme things that could happen. First of all, China owns over $1 trillion of US treasuries, and they can sell those treasuries and cause a lot of problems in the US. Secondly, China could start imposing restrictions on US companies that operate in China. They could say, no more iPhones, no more Starbucks, things like that. China is a huge market for many American companies. That could cause a lot of problems. Or they could have travel or study restrictions in terms of Americans coming to China or Chinese people going to America. So there definitely is more room for escalation if there's no negotiated outcome, but extreme retaliation is not our base case. And lastly, I'd just like to highlight that in terms of this whole trade war, it's very easy to get fixated on the trade deficit and this level of tariffs and very specifics about it. But if you take a step back, our view is that the trade war is just one part of a much bigger thing that's going on. And it's the rise of China and the hegemonic decline of America. And if you take that long-term view, that is not something that's going to be solved with one handshake between Trump and Xi at one meeting. It's a longer-term thematic. And we have a lot of things in the portfolio that are positioned to benefit from the rise of China. Okay, this slide is actually very important because if you read the newspaper, a lot of the commentary seems like China's just sitting there and is just going to take all the pain from the trade war. But China, our impression is that Chinese leadership is not going to accept a hard landing. They're not going to let the economy hard land because of the negative implications of a trade war. So the good news is China has many policy levers that it can pull to ensure that the economy stays chugging along despite what happens in the trade war. For example, they can loosen monetary policy. Unlike G3 countries, Asian countries never had QE, so they have interest rates which are still decently high, and they can cut interest rates. In China specifically, they have reserve requirement ratio. They can cut that, and they have done that by 350 basis points in the last few years. They can have expansionary fiscal policy, particularly on infrastructure. This is something that is already been talked about, but there's not very many specifics. And they can also depreciate the currency. So as you can see, the RMB has depreciated around 7-8% year to date. And there's some economists that calculate that roughly offsets the tariffs that have been applied to the first $200 billion of goods. So China can just use the currency to offset some of the impacts of the trade war. So, as I said at the beginning, we have not changed the portfolio at all for about 9 months. I'll get to later how we positioned about 9 months ago. But we do have 2 different lists back at the office. Like I said, I feel like we're closer to the floor than to the ceiling. When Asian markets do turn around, what do we want to buy? It kind of depends on why markets turn around. If markets turn around in Asia because the trade war is de-escalating and there seems like there's some resolution in sight, then there's certain stocks that you want to buy. If markets turn around because the trade war doesn't seem like it's going to be resolved or de-escalated at any time, but China does a really big stimulus to support its own economy, then that's a different sort of set of stocks that you want to buy. So we're ready to go for either event. Okay, I'll just talk a little bit about emerging market sell-off because this kind of often gets lost in the noise, but it's not just China that's sold off and it's not just the trade war that's going on. As you can see from the chart on the left-hand side, there is a very clear inverse relationship between strength in the US dollar, that's the gray line, and the performance of emerging markets. And so as the US has raised rates and normalized monetary policy, that's caused upward move in the US dollar, and that has been negative for emerging markets. Asia is about 70% of emerging markets, and most of the really big large cap stocks that are in the emerging markets index are the Asian stocks. So Asia, particularly China and some of the Chinese tech companies, have been hurt by those passive outflows that are going out of emerging markets. The chart on the right-hand side is currencies, and this is quite important to realize if you own an LIC based in Australia, denominated in Aussie dollars, that invests offshore. So, a lot of the currencies have depreciated, obviously, as the US dollar has gone up, but so has the Aussie dollar. So Hong Kong dollar is pegged to the US dollar, and around 40% of our portfolio is in Hong Kong dollars. So as the Aussie dollar depreciates, this is a positive for our portfolio in absolute terms. Okay, and then I'll talk just a little bit about Chinese tech leadership. 2017 was an absolutely fantastic year for Chinese tech. Some companies like Tencent and Alibaba doubled or almost doubled, but they have turned the corner in 2018. It hasn't been quite as rosy. And some, the Chinese MSCI China Tech Index is down 25% versus NASDAQ, which is, well, when I wrote this slide, it was up for the year. Now it's down a little bit. But again, you can see those really big jaws between how US tech has traded and how Asian tech has traded. The good news now is that Asian tech valuations are very, very reasonable. You can see the big gray bar on the right-hand side is the average PE of the FANG stocks. That's at 40 times PE still. Whereas you look at BAT, that's Baidu, Alibaba, and Tencent, the three big China tech companies, they are trading at 21 times PE. So I'm not an expert in US tech, but I don't think that they should be trading at half the multiple of their peers in the US. So we think that there's going to be a lot of interesting opportunities coming up in Chinese tech in the next few months, and we are doing the work now so that we're ready to go when those opportunities present themselves. Okay, I'll talk a little bit about portfolio. Before we get into actually what we own, I just wanted to give you a sense for how we keep in touch with the companies in which we've invested, and how we go about making decisions for investing in our companies. So the first is we spend a lot of time on the ground in Asia, and we do have close relationships with our companies. We are not sitting at our desks in Sydney just plunking away on numbers and with no sense of what's going on the ground. We have personal relationships with all the companies in which we invest. So over the last year, me and my team, who are all here this morning in the front row, if anyone wants to talk to them after, spent over a third of the year on the ground, 115 days, and we visited 15 different cities in 8 different countries. So we are not the kind of team that goes to a conference in Hong Kong and Singapore and takes an Uber to the 5-star hotel and spends 2 days there and goes back to the airport and flies back to Sydney. Instead, we spend time on the ground. We kick the tires on the ground, which you'll see in the next few slides. So this is on the ground in China. Many of these pictures are for Eric Fong, who spends usually a couple months in China every year. And we visit our portfolio companies, we visit their competitors, and for certain like consumer stocks, we try to experience the product ourselves. So this is some of the pictures from on the ground in China. This is on the ground in Korea and Taiwan. Those are Freddy Ho's markets. He's gone to Asia 5 times in the last 12 months, so spent a lot of time on the ground. And we do visit the consumer side, and then like TSMC, we do visit factories and really kick the tires from a manufacturing perspective when we can do that. And then lastly, on the ground in India and ASEAN, I went to Vietnam. Vinamilk was a company that we were interested in. I went to a grocery store and looked at their shelf space, tried the product. Jollibee was a company in the Philippines that we were interested in. So I was actually trying to make a video for our shareholders in this one, but it was so noisy at Jollibee with like hundreds of people trying to get their stuff for lunch. You couldn't hear. So anyways, I just took a picture. Maruti Suzuki, India is the market that Vinay focuses on. He was in India a few months ago and went to visit a Maruti Suzuki dealership and literally kicked the tires on one of the stocks that we really like. HomePro is a company in Thailand. It's sort of the Bunnings of Thailand, and I went to visit that stock last time I was in Thailand. So we spend a lot of time on the ground, and we have really close relationship with our companies. So moving on to how we're positioned. As many of you who may know, for about the last 9 months, we have been really positioned in terms of domestic demand stories. So I'll tell you a story. Remember before even the US-China trade war started, Donald Trump came out with the tariffs on steel. And this was global tariffs on steel. We had one steel company in Korea, and they had about 2% of their sales to the US, and it was a 25% tariff on that 2%. So that's a very small impact on earnings. So we crunched the numbers and thought this isn't really a big deal. The stock dropped anyways. So that was actually a very helpful thing for us, because I said, you know what, we are not going to take the risk that we're in all these supply chain companies and we're in a lot of exporters. And at the end of the day, the impact of the trade war might not be too much on them, but investors are in a mood to shoot first and ask questions later, and I don't want to be in these stocks when they're rolling over for non-fundamental reasons. So at that point, we really oriented the portfolio towards domestic demand names. So in China, we don't own any exporters. We own exclusively banks, insurance, domestic-facing tech, and consumer companies. That's it. And also, we wanted to orient the portfolio towards domestic demand-driven economies. So India is probably the biggest example here. India is outside the fray of the trade war. It's doing its own thing. GDP is growing 7.5%, and so we had a decent amount of the portfolio in India. So that's sort of how we're positioned. We continue to be positioned that way right now. From a sector perspective, financials are our biggest sector. We have about 35% of the portfolio in financials, and there's a very specific reason for this. As I said at the beginning, we are a growth fund, and financials offer great growth in Asia. As you'll see a slide later on, it's actually much better than the growth and the valuation that you get in Australia. Financials also are low PE stocks. So they're low PE stocks. What you've seen happen recently is that there's been a rotation out of high PE stocks into more value-oriented stocks. And financials have sort of been in the sweet spot because they still meet all our growth criteria, but they're trading at very low PEs. So that's one of the reasons we like financials. Secondly, some of the financials we own, namely the Singapore banks like DBS and OCBC, and Hang Seng Bank in Hong Kong, they are beneficiaries of rising rates in the US. So if rates rise in the US or rise faster than people anticipate, the dollar goes up and emerging markets don't trade very well, at least the banks that we own in the portfolio will do very well in that sort of environment. We do have a lot invested in tech. As you've maybe heard me say before, we think that technology in Asia is one of the main reasons to invest there. There's no tech available domestically. The tech that is here is very expensive. And so we think that technology is a very promising sector in Asia. And lastly, cash is around 12%. So if markets do turn around, we can deploy that very quickly. But it is a decent amount of cash that we've been holding fire as markets have sold off. In terms of the top 10, I'll just highlight that it's about 44% of the portfolio are in the top 10. So we are a concentrated fund. We're not out there buying 100 stocks and sort of acting like an index. We only have 31 stocks in the portfolio at the moment, and it's very concentrated in the top 10. I'll just talk quickly about some stock ideas. Tencent is one where I'm getting a lot of questions. We are getting many, many questions on China tech. Tencent is the biggest position in the fund, and it has traded down quite a bit this year. As I said, it had a great year in 2017, but has traded off a bit. The valuation is very compelling right now. You can see from the chart on the right-hand side, the PE is one standard deviation below its average, and it's very compelling on absolute terms also. The long-term thesis remains intact for Tencent. There has been some regulatory issues. They restructured the regulatory body that approves games that people play, Tencent games that people play, and that has created some earnings uncertainty. But we are hoping that that gets resolved sometime between now and March 2019. Reliance Industries is also a stock in our top 10 that wasn't in our top 10 last year, so I thought I would comment on it. Reliance Industries is an Indian stock, and the market cap is over 100 billion. I mention that because a lot of people think of India as a very small market, and they say, oh, I didn't know there were any stocks in India with market cap of over 100 billion. So Reliance is a very big company, and it has 4 world-class, high-quality business. The sort of old economy businesses are refining and petrochemicals. Reliance has the largest refinery in the world, not in India, not in Asia, in the entire world. You can see a picture of it on the left-hand side. And the refining capacity of Reliance is 3 times the entire refining capacity of Australia. So this is a really, really big operation. Petrochemicals, similarly, these are cash cows. They generate a lot of cash, and they're good, stable businesses. Then you also have retail. Reliance is the largest retailer in India with over $10 billion of sales. They are planning to spin that business out separately, and we'll get a valuation uplift when they do that. And then telecoms is the last business. Reliance just went into telecom a few years ago, and they already have 250 million subscribers. So just think about that in the Australian context. That's like everybody in Australia getting 10 phones in less than 2 years. So they've done a really good job of building that business up, and they've recently just launched their own Geo phone. RGeo, Reliance Geo is the name of the telecom business. And as you can see from this photo, that phone costs $40. It's not a really smart phone. It's like a highly intelligent phone. So there's a camera on it, there's connectivity, there's storage, there's display. There's a lot of things you would get on an iPhone, but it only costs $40. And we're quite excited about these kind of things in India because it just means technologically India can leapfrog, and there's a lot of opportunities that come from being in this market. And then I'll just quickly talk about banks. We really like banks, as I said before, and comparing them to Australian banks, the average PE in our portfolio is 10 times versus Australian banks at 12 times. The average growth in our bank's portfolio is 13%, whereas Australian banks, the big four on average, have negative growth this year. So you can't even calculate the PEG ratio. That's really bad if you can't even calculate it. And ROEs in our bank's portfolio are 14% versus 12% for the Australian banks. So lastly, I'll just touch a little bit on the stock. The most recent NTA is 103, and next week we do have weekly NTAs. For those of you that are interested, you'll get the next weekly NTA on Tuesday. We have paid our maiden dividend, as Brian mentioned, and we have option expiry coming up. The world and the markets could be very different by the end of February, so we are committed to keeping in touch with you and making sure that everybody knows what the NTA is going into February. So with that, I think I'll turn it over to Bill. Thank you very much for your attention.